Hi everyone, my name is Piterpakulski. Today it's time for us to have a final overview of a nail salon financial model that we've created from scratch. So I'll be giving all the links on the process of creation in the description of this video, so you can just follow the video, you follow video by video creating, looking at the formulas. So I'll be giving the links on creation of this financial model in the description of this video. I hope you enjoyed the process. I hope you will find this information valuable. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. So let's start with inputs. So the basic rule for the model is that the cells the blue cells are inputs, all other cells are formulas, so we are not touching any other cells which are not blue. So we can play creating different scenarios with blue cells. So this is the unique color of inputs through the whole financial model. So the first input is the first year of financial projections. Then we have a list of nail salon services. So here we can just name all these services. Then we specify prices for these services. Then we have on-off, switch on and off button to be able to switch on and off this or that service from calculation and see what will happen with financial efficiency, with simple, discounted payback period, financing needed, if we switch on and off this or that service from calculations. Then we have coefficients for scenario play for pricing without adjusting these values, so we can just play with coefficient. Then we specify the value of the percentage of direct expenses from these prices. Here it is. Then we also have coefficient to direct expenses. So these are the values of direct expenses of these services. Then we have direct expenses to a coefficient which works with these direct expenses values. This is also will be needed for scenario play. So for example, if we've created some scenario, see for example the values of financial efficiency, and we would like to, for example, see what will happen if they will go 20%. So we can
just do like this. We can go back, see what will be the financial efficiency. So it is a very fast way to create numerous amounts of scenarios, playing with data, get acquainted with your business idea without adjusting the data, the inputs manually. Then we have the inputs, the input of duration of services, how much time does each service takes to produce. We also have coefficient to duration of the service, because we will also have to play with the timing. Then the next block of input, where we specify, so we take the typical week from Monday to Sunday, and we can specify how many services per day we're going to produce. So here we have the names of services, here are the amount of services that we are going to produce each day. So we are just describing one workplace. So this is our starting point. So we're describing just per one workplace how many services we are going to produce. Then we specify. We can also add some coefficients. So how many. We can add a sales plan coefficient to this or that amount of services that we produce. So we can add this coefficient to these services, this coefficient goes to this amount of services. So we can also play, for example,
So this is the basic scenario. If we, for example, have only 7% of this amount of services, what will happen with financial efficiency here? So we are creating a huge amount, a system, an environment of coefficients to be able to play with them after the financial model is ready. So this will be very important at the last step of your financial modeling. Then so these coefficients work for specific day. So so this coefficient is linked to the day sales plan, and these coefficients are linked to the sales plan to specific service. So this coefficient is linked to this, and this coefficient is linked to this. So we can play inside the week from Monday to Sunday, and we can also play with this or that specific service, a sales plan. So this is very interesting for you. This will be very interesting for you to know how these coefficients affect your revenues, expenses, simple, discounted payback period. Then you specify the working hours. So how many hours a day your nail salon will be working from Monday to Sunday. Then you see the time occupancy. So for example, on Monday you have 14% of time occupancy. In Tuesday it is 88%. So depending on duration of the services, depending on the amount of services delivered. So for example, if we decrease the amount of working hours here, we can see that our nail salon can produce this amount of services, and it is the signal alarm for the business owner to rethink the business concept. So this is the system of alarming instruments that help entrepreneurs see the mistakes and inputs in time to remove pink glasses from your head. So this is very important to see that you can't produce this or that amount of services, and you have to decrease the sales plan, because you can't work, for example, 35 hours per day, and you will be able to see these mistake in time. You will decrease the amount of services. Here you will see the realistic revenues, you will be able to see the realistic expenses, you will be able to see the realistic profitability, amount of financing needed, cash flow generated, and so on. So you will be living in the world of real numbers. So then we are adding seasonality coefficient for our nail salon. So 100% means that we have basic planned, so we have the basic revenues, but for example in summer we will have some decrease in revenue. So here we have the typical year. Here we have the typical year, and inside this typical year 100% is maximum, and if we have some decrease in seasonality, we can specify it here, for example. Then the next block is of inputs is here we specify the moment when we start operating activity, when we get the first revenues. So here we specify year, month, when we start our nail salon, the operating activity, when we get the first revenues. And then we specify how fast we are reaching the planned revenue. So for example, if we start in March, we will get only 3% of the revenues that we planned. The next month operating activity will bring us 5% of planned revenues, 15, 30, 50, and then we will be able to see step by step the reaching of the 100% of revenues that we planned earlier. So the essence of this exercise is that So we have some sales plan here, but we will be reaching these sales plans step by step. And the way we are, so this is basic sales plan is 100%, and we are starting only from 3% of this sales plan and reaching the sales plan step by step. We can specify the way we are reaching it and why we need that, because at the first month when we start, your total expenses can be much higher than your revenues, and you will have operating losses, and you will have to add some financing, extra financing from your pocket or from your business partners, or if you're from the bank loan, to finance your business ideas. And all these operating losses will depend on the way you are reaching the planned revenues. So this is a very important block of inputs, because many entrepreneurs have been future business owners. They just start playing with these percentages. They go to the cash flow statement. And look here the result of operating activity, and see how much negative months of operating losses they have, if they reach faster or with a slower speed. So all these operating losses will have to be financed from your own pocket, or from the bank, or from your business partners. So depending on the percentages you will be setting up, here, you will be able to see the difference in total financing needed to start your business idea. So this is a very interesting exercise will be for you. Then you specify the payroll for one workplace. So here you will specify the amount of people working on this position, their salaries, the amount of people on this workplace. Then you specify how much percentage of bonuses from revenues you're going to pay them. Then you specify the fixed expenses per one workplace. So here specify the fixed expenses items, how much you pay these expenses monthly. Then you specify the investment plan for this workplace, or for just one workplace, the price of, for example, equipment, how much of this equipment you need to start this workplace, what is the kind of equipment you need. Then you specify how many workplaces are going to have in your nail salon. So 4, 1, 3. If you have an individual nail salon, just one working place, you just place here 1. Then you have a group of coefficients for all the revenues, for all direct expenses, payroll, fixed expenses, investment plans, so you can easily play with these coefficients. So basic value is 100%. You can increase the revenues. So for example, you can look what will happen to your business idea if revenues increase on 20%. You can go here, see what will happen with financial efficiency. If you decrease the revenues, for example, you will take 90% of current revenues, what will happen with financial efficiency. So this is quite an interesting exercise for you to get acquainted with your project. So these are basic coefficients to revenues, direct expenses, payroll, fixed expenses, investment plan. Then you have some overhead expenses, other expenses that are not closely connected to the amount of workplaces. So you have additional payroll, like for accountant, for receptionist, and so on. So here are the names of positions, salaries, amount of people on each position. So this is additional payroll that is not connected to the amount of workplaces. This is fixed expenses, for example, rent or advertising, and so on. So this is overheads, additional fixed expenses which are not connected with amount of workplaces. This is additional investment plan, which is also not connected to the amount of workplaces. Then you specify the amount of loan, whether you have it or not. So this is the amount of loan, term of loan in months, interest rate, grace period for principal payments, grace period for interest payments, when you take this loan, month and year, so you can specify it here. Then you specify the rates of taxes, revenue tax, payroll tax, profit tax, how much asset tax you pay monthly. Then you finally go to cash flow statement. Here you can see the revenues, direct expenses, payroll, fixed expenses, taxes, their totals. You can see the result from operating activity. This line will show you how your business breathes itself without loan burden. So this is the way it operates. And here is the loan burden, loan expenses. So revenues minus direct expenses minus payroll minus fixed expenses minus taxes. So here you can see how your business works just clearly without any external expenses like loan. Here you can see the investments needed before you start operating activity. Here you can see how much money you need before you start operating activity. So you need so this is the investment before you start the revenue. So here is the first revenue. Here are the investment before the revenue begins. Here are operating losses when you have the revenue but you didn't reach the break-even point. Here is also some expenses that you have to pay here before you reach the break-even point, because you earn, for example, here just a $6,000, but your payments for the loan will be much bigger. Then you can see how much financing you need to start the business. So here is the equity, the money from your pockets or from investor. This is the loan. Here are the simple totals: equity, loan, totally financing needed for the business idea. Here you can see how the project spends the cash. Here is mathematical zero, and here is how the project starts generating on cash. What balance at the end period, the end of the project, or at the you can see the cash balance by the end of this or that month and year. So this is very interesting for you to see what amount of cash is generated at the end of by the end of this or that month and year. So then you can see a simple table where you have all the revenues, all the expenses. Here are the profits, here is profitability. You can see how the business works inside the timeline with all the revenues, total expenses, profits, profitability. Then here you can see the simple discounted payback period, discounted payback period diagram. So this is the moment when your project has a payback period moment, payback moment. So here is when all the financing that was put in the business is brought back. So this is the simple payback moment, and here is the discounted payback period moment. So it is occurs when this diagram crosses the timeline, the timeline axis, or X usually. Then on the next tab we specify the level of discount rate. We specify the step of discount rate changing to calculate internal rate of return. And then we have a sensitivity analysis where all the financial efficiency is gathered. Here we can specify the step of changing parameter. So for example, we can specify the step, for example, it changes here. Then we can for example delete data from here. We can go to the to our inputs and see, for example, how revenue tax affects the financial efficiency. We can just add the sensitivity analysis parameter to the revenue tax. Now we can press the sense button and see how our business idea behaves if the percentage, if the rate of revenue tax will increase or decrease on 8%, or this will be just 89%, 92% of base value. So just press the sense button. So now we can see how the financial efficiency behaves, or we can, for example, we can change the step. So this is quite an interesting exercise. You can just add sensitivity analysis parameter to any input. So for example, we can delete the link sensitivity analysis parameter from revenue tax and add this parameter to, for example, to the payroll. So we can to the payroll coefficient, for example. So we added coefficient, then we go back, then we press sense button, and now we can see what will happen if payroll expenses will increase on 10%, 20%, 30, 40% of the basic of the base value. What will happen to the project if the this level of expenses will decrease? Also, we can, for example, change the step and increase the interval, general interval of these parameters. So we can just press sense button again, so using this instrument you can just add, if you add the sensitivity analysis coefficient to any input, you will be able to see how this or that input affects the financial efficiency of your business idea, whether your business idea is stable or not, what is the level of the stability of your business idea, what adjustments of revenue and expenses of the inputs will bring your business idea to losses. So this is a very interesting thing. You can just rethink your business concept in time before you launch, because this will give you a huge portion of information in time, because you can play with inputs, create numerous amount of scenarios and see what is happening with your business idea if this or that parameter increases or decreases. So this is a very interesting story. So maybe this video was useful for you. I'll be giving all the links on the creation of this financial model from scratch in the description of this video. So you may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. So see you guys in next videos. Thank you and bye.